In 1929, the American dream became a nightmare overnight. The stock market, the engine of the roaring 20s, did not just stumble, it evaporated. Over 3 agonizing years, stocks plummeted by 89%. Unemployment exploded to 25%. Families who had been planning vacations were suddenly standing in bread lines. Banks failed by the thousands, and life savings, money meant for retirement, for education, for safety, were wiped out in a heartbeat. It took a staggering 25 years for the market to claw its way back to the levels seen in 1929. An entire generation lived and died in the shadow of that crash. Then, we thought we had learned our lesson. But history is a wheel, and in 2008, it turned again. The housing market, built on a foundation of lies and greed, collapsed, triggering the Great Recession. Stocks fell 57% in just 18 months. Unemployment hit 10%. Retirement accounts were devastated once more. It took 5.5 years for markets to recover. These were the 2 greatest financial calamities of the last century. But I am here to tell you a terrifying truth that few are willing to whisper, let alone shout. 2025 is different. It is not just a recession. It is not just a correction. We are staring down the barrel of a financial singularity this time. Stocks, bonds, and real estate are all crashing simultaneously in what financial historians and terrified economists are calling the everything bubble. And here's the cold, hard reality. When everything crashes together, there is nowhere to hide. What if I told you that we are not in a new situation, but rather we are reliving the final days of 1928, right before the sky fell? Except this time the situation is mathematically worse. Why? Because the tools that saved us after 1929 and 2008 no longer exist. They are broken. They are used up. The Federal Reserve cannot cut interest rates to 0 to stimulate the economy because rates are already relatively low, and they risk reigniting the fires of inflation. They cannot print unlimited money because they just did that during the pandemic, causing the worst inflation crisis in 40 years, destroying the purchasing power of the middle class. The government cannot bail everyone out this time because the government itself is drowning in $36 trillion of debt. The lifeboat is full, and it is leaking. Let me take you on a journey through the mathematics of the coming collapse. Let me show you why every major financial indicator, not some of them, all of them, eats flashing red. Let me explain why the crash window is mathematically projected between November 2025 and June 2026, and why the coming wealth destruction will likely exceed any event in recorded human history. This is not speculation. This is cold, unyielding mathematics. To truly understand why 2025 stands alone in the history of financial disasters, you must first understand that we are not dealing with a single bubble. In 1929, we had a stock bubble. In 2008, we had a housing bubble. Today, we are trapped inside 3 simultaneous massive bubbles that have never occurred together in financial history. Let us start with the first bubble. The stock market, the S&P 500, is currently trading at a price-to-earnings ratio of 28. To put that in perspective, the historical average is between 15 and 17. We are nearly double the historical norm. This level of extreme overvaluation has only occurred twice before in American history. Once in 1929, right before the Great Depression began, and again in 2000, right before the dot-com crash destroyed 78% of the Nasdaq's value. Both times, without fail, the market crashed within months of hitting these extremes. But the danger in 2025 is not just about high prices. It is about concentration. The market today is standing on the shoulders of 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. The 2 so-called Magnificent Seven represent approximately 30% of the entire S&P 500's total market value. This is a level of fragility that is terrifying. It means that if these 7 companies sneeze, the entire global economy catches a cold. If they crash, they take the pension funds, the retirement accounts, and the entire market down with them. This concentration is even more dangerous than what we saw in 1929. Back then, a handful of industrial stocks held up the market. In 2000, it was tech stocks, but today's concentration is extreme. Look at Nvidia. This single company illustrates the absolute insanity of our current financial reality. It trades at a price-to-earnings ratio of 65. That means investors are currently paying $65 for every single dollar of profit the company generates. Nvidia's total market value exceeds $3 trillion. Think about that. One chip company is worth more than the entire stock market of Germany, the 4th Einjit economy on the planet. This is not rational valuation based on fundamentals. This is pure, unadulterated speculation driven by Artivinet mania of 1999 exactly. Back then, everyone believed the internet would change the world, and they were right. The internet did change the world, but they were catastrophically wrong about the short-term stock valuations. The companies that changed the world still lost 90% of their value in the crash. The same thing is happening now with AI. We are in a euphoria that blinds us to the cliff we are running toward. The second bubble is real estate, and the data here is even more alarming. We often look back at 2008 as the ultimate housing crisis, but the reality is that 2025 makes 2008 look manageable. In November 2025, home prices are sitting approximately fint relative to income and rent at the absolute peak of the bubble. In 2008, homes were only 35% above the trend. This means the current housing bubble is 43% larger than the bubble that nearly destroyed global capitalism 15 years ago. Let that sink in deeply. The crisis that required trillions in bailouts, that left neighborhoods abandoned, that ruined millions of lives, was caused by a 35% overvaluation. We are now at 50%. Most people do not even realize we are in a bubble because prices have been high for so long that this insanity feels normal. It feels like the new baseline. But gravity always wins, and it is not just residential real estate. Commercial real estate is currently in freefall, creating a slow-motion disaster that will accelerate through 2025 and 2026. Office buildings across major American cities sit 45% vacant as remote work becomes a permanent feature of the economy. In San Francisco, the vacancy rate is 35%. These massive towers were financed with mortgages when interest rates were financed. The rates are now 7 to 9%. The math is broken. The buildings are not worth enough to support the new debt service at triple the interest rate. This guarantees defaults. It guarantees bank losses. It guarantees a cascade of failures that will mirror the 2008 subprime crisis, but this time in commercial properties, ripping through the regional banking system. The third bubble, and this is the specific factor that makes 2025 unprecedented and truly terrifying, is the bond market. For 100 years, government bonds were the safe haven. They were the bedrock. When stocks crashed, you bought bonds. In 1929, bonds were safe, even as stocks collapsed 89% in 2008. Treasury bonds rallied as investors fled stocks for safety. But in 2025, because the United States government has issued so much debt that the bond market simply cannot absorb it anymore. Total federal debt exceeds $36 trillion. That is approximately 125% of GDP. This is the same debt-to-GDP ratio America had at the end of World War II. After World War II, America was the only major industrial economy left standing. It was the factory of the world. Today, America is deindustrializing, competing with nations that have lower debt and stronger manufacturing bases. The annual interest payment on this massive pile of debt now exceeds $1.2 trillion per year. Interest on the debt is now the single largest line item in the federal budget. It is larger than defense spending. It is larger than Social Security. When your credit card interest payment is larger than your rent and your food budget combined, you're bankrupt. The government is mathematically insolvent. The government has three options, and all of them are catastrophic. 1. Cut spending drastically. This would cause an immediate severe recession. 2. Raise taxes drastically. This would crush consumers and businesses, causing a recession. 3. Print money to pay the debt. This would cause hyperinflation, destroying the dollar. There is no good path forward when your interest payments alone equal the entire GDP of Mexico. This is the everything bubble. Stocks are overvalued at levels only seen twice before disasters. Real estate is more overvalued than in 2008. And bonds, the traditional safety net, are burning down under the weight of unpayable government debt. The parallels between 2025 and 1929 are so precise that it is like watching a horror movie remake where you know exactly who dies next. The price-to-earnings ratio of the Dow hit 33. Today we are at similar levels. The public in 1929 believed that new technology, electricity, radio, the automobile, had created a new era where old rules did not apply. This time is different, was the mantra. In 2025, replace radio with artificial intelligence, and the delusion is identical. In 1929, margin debt reached record levels. Everyone from doctors to shoeshine boys leveraged themselves to buy stocks. Today, retail options trading has exploded. People are using credit cards with 25% interest rates to buy stocks. Companies are borrowing money to buy back their own shares at all-time highs. The leverage is everywhere, hidden in derivatives and shadow banking. Wealth inequality is another perfect parallel. In 1929, the top 1% controlled about 25% of total income. The economy was top-heavy. When the rich stopped spending, the system collapsed. In 2025, wealth inequality is even worse. The top 1% controls approximately 32% of total wealth. The economy is entirely dependent on the consumption of the top 10%. If their stock portfolios crash, consumer demand evaporates instantly. But here is where 2025 is actually worse than 1929. In 1929, only about 10% of American households owned stocks. When the market crashed, 90% of the population watched from the sidelines. They suffered later, yes, but their initial savings were not wiped out by the ticker tape. In 2025, approximately 58% of American households own stocks, either directly or through 401k and IRAs. We have financialized the entire society. This means that when the market crashes this time, it directly destroys the retirement savings of more than half the country. There is no insulation. There is no buffer. Everyone bleeds immediately. Let us look at the banking sector. In 1929, we had thousands of small, fragile banks. When they failed, savings vanished. Today, we are told we are safe because of FDIC insurance. We are told our deposits are protected up to $250,000. But do you know how much money is actually in the FDIC insurance fund? About $125 billion. Do you know how much they insure? Approximately $10 trillion in deposits. The ratio is laughable. If multiple large banks fail simultaneously, beat is exactly what happens when commercial real estate collapses. FDIC fund will be drained within days. The government would then have to print trillions to cover the deposits, which brings us back to the doom loop of inflation. You either lose your money to bank failure or you lose your money to inflation because the government printed it into worthlessness. Pick your poison. The Federal Reserve in 1929 had credibility. They had room to maneuver in 2025. The Fed has spent 15 years proving it cannot manage the economy. They inflated the bubble with quantitative easing. They kept rates too low for too long. Then they panicked and raised rates too fast. They have lost credibility. And more importantly, they have lost their ammunition. In 2008, interest rates were at 5.25% when the crisis started. The Fed could cut all the way to zero. That was a massive stimulus. Today, rates are already relatively restricted. If they cut, inflation explodes. If they don't, the depression deepens. They are trapped. Quantitative easing is also off the table. The Fed's balance sheet is already bloated to over $7 trillion. They cannot just buy another $4 trillion in bonds without signaling to the world that the dollar is essentially monopoly money. The inflation surge of 2021 proved that there is a limit to money printing. We hit that limit. We crashed into that wall. We cannot use that tool again without destroying the currency completely. The bailout capacity of the government is also exhausted. In 2008, federal debt was 67% of GDP. It was manageable. The government could borrow $700 billion for TERP, and nobody blinked today, with debt at 125% of GDP. The government does not have another $2 trillion lying around to bail out banks. If they try to borrow it, bond markets will revolt, interest rates will spike. The debt service will become impossible. The bailout option that saved capitalism in 2008 simply does not exist in 2025. Furthermore, the international situation is dire. In 2008, China was booming. China effectively. Today, China is in its own Great Depression. Their real estate bubble has burst. Their local governments are drowning in $13 trillion of debt. Their population is shrinking. China cannot save us. Europe is stagnant, dealing with energy crises and war. There is no engine of growth left in the global economy. Geopolitical tensions mean that instead of the G20 coming together to save the world, nations will be fighting over scraps. The warning signs are not subtle. They are screaming. The most reliable predictor of recessions in history is the inverted yield curve. When short-term rates are higher than long-term rates, a recession follows. This indicator has a 100% accuracy rate over the last 70 years. It predicted every single recession since 1950 with 0 false positives. The curve inverted in July 2022 and stayed that way for 27 months. It normalized in September 2024. History tells us the recession typically begins 3 to 12 months after the curve uninverts. That puts us squarely in the danger zone right now. The alarm's been ringing for 2 years, and people have grown tired of the noise, so they have decided to ignore the fire. But the fire is here. Consumer debt is another flashing red light. Credit card debt has smashed all records, exceeding $1.14 trillion. The average household carries nearly $7,000 in credit card debt at interest rates exceeding 20%. Delinquencies, people who are 90 days behind on payments, rising to levels not seen since the Great Financial Crisis. The consumer is 70% of the U.S. economy. When the consumer is maxed out, when they can no longer borrow to spend, the engine stalls. We are at that stalling point right now. Then there's the slow-motion train wreck of commercial real estate. Over $2 trillion in commercial mortgages are coming due for refinancing. A building that made a profit at 3% interest is bankrupt at 8%. It is simple arithmetic. Building values have dropped 40 to 60% in major markets. When these loans default, who holds the bag? Regional banks. We saw a preview of this in 2023 with the collapse of Silicon Valley Bank, Signature Bank, and First Republic. Those were the tremors. The earthquake is coming. When dozens of regional banks fail simultaneously due to commercial real estate losses, the panic will be uncontrollable. And then there is the Magnificent Seven. Nvidia alone accounts for a massive percentage of the S&P's movement. If AI hype fades, if earnings disappoint, if there is a regulatory crackdown, the unwind will be violent. Algorithmic trading will exacerbate the crash in 1987. Program trading caused a 22% drop in a single day. Today's algorithms are faster, more interconnected, and more ruthless. When the selling starts, there will be no bids. Look at what the smart money is doing. Insider selling is reaching a fever pitch. Jeff Bezos, Mark Zuckerberg, the executives at Nvidia, are selling billions of dollars of their own stock. They are cashing out at the top. They know the valuations are unsustainable. They are not buying, they are selling to you. And the greatest investor of all time, Warren Buffett, is holding more cash than at any point in the history of Berkshire Hathaway. Over $325 billion in cash in treasuries. He is selling stocks, including his beloved Apple. Why? Because he cannot find anything to buy. His own metric, the Buffett indicator, which measures total market value against GDP, is at 185%. Anything over 120% is dangerous. At 185, it is suicidal. Buffett is sitting on the sidelines, cash in hand, waiting for the blood in the streets. He knows what is coming. He has seen it before. Unemployment is the final domino it has started to rise. The SOM rule, a highly accurate recession indicator, has been triggered. This rule states that when the 3-month moving average of unemployment rises by half a percentage point from its low, a recession is underway. We are there. Auto loan delinquencies are spiking. Student loan defaults are surging. The pressure is building in every corner of the economy. And let's not forget the guillotine powder kegs. War in Ukraine, conflict in the Middle East, tensions over Taiwan. Any one of these could trigger an oil shock or a supply chain collapse that pushes the fragile global economy over the edge. So how does the crash happen? It won't be a straight line. It will be a cascade. It might start with an earnings miss from a tech giant or a bank failure or a jilting shock. The trigger is irrelevant. The instability of the system is the cause. As stocks fall, margin calls will go out. Investors who borrowed money to buy stocks will be forced to sell to cover their loans. This forced selling drives prices lower, trigger more margin calls, trigger more selling. It is a feedback loop from hell. Almets will detect the trend and short the market, adding massive downward pressure. Institutional investors with risk parity models will be forced to sell as volatility spikes. Within weeks, the market could be down 30 to 40%. As stocks crash, pension funds and retirees see their wealth evaporate. Consumption stops, business fire workers, unemployment spikes. This leads to more defaults on mortgages and credit cards, which weakens the banks further. The banks pull back lending, starving small businesses of capital, more bankruptcies, more unemployment. It is the classic deflationary spiral of the Great Depression, but moving at the speed of fiber optic cables. And here is the nightmare scenario for the housing market. As jobs are lost, people can't pay mortgages, but unlike 2008, they also can't sell their homes because interest rates are so high that no buyers can afford the monthly payments. The market freezes. Prices have to collapse 40, 50% to find buyers. Millions of Americans find themselves underwater, owing more than their home's worth. Their primary asset becomes a liability. The psychological toll will be immense. We are talking about the destruction of the middle-class lifestyle. Retirement that was supposed to be comfortable becomes a struggle for survival. Young people graduating into this economy will face a lost decade of stagnant wages and zero opportunity. The social and political consequences will be severe. Economic desperation breeds political extremism. We saw it in the 1930s. We will see it again. When people lose everything, they look for someone to blame. The social fabric, already tearing, could rip apart completely. This is why 2025 is worse than 1929 and 2008 combined. We have the asset bubbles of 1929, we have the debt bubbles of 2008, and we have a sovereign debt crisis that is entirely new. We have used up all our lifelines. The Fed is powerless. The timeline is ticking, the yield curve has normalized, the warning window is open. Between now and the middle of 2026, the mathematics of unpayable debt and overvalued assets will resolve themselves. And in economics, resolution is a polite word for crash. This is not a probability, it is an inevitability. The system cannot sustain this level of imbalance. It must correct. And the correction will be the most painful economic event of our lifetimes. The everything bubble earned its name because everything crashes together. Stocks, bonds, real estate, cryptocurrencies. There is nowhere to hide except perhaps in tangible assets, in skills, and in resilience. The market crashes in the history books, the ones we thought were black and white photos of a bygone era, as about to come vividly back to life. The violence and scale of this correction will shock everyone who believes that it can't happen here. But the math does not care about your beliefs. The math says the debt is unpayable. The math says the valuations are impossible. The crash is coming. The only question remaining is not if or even when, but simply this: will you be prepared when the music stops?